Ron Insana says the risk of a bear market is rising. He's a CNBC senior analyst and commentator, also a senior advisor to Schroders North America. Also with us, Michael Farr, chief market strategist with Hightower Advisors and president and CEO of Farr, Miller and Washington. He is also a CNBC contributor. Gentlemen, welcome. Good to have you with us. You've heard a couple of perspectives here, Ron. One suggesting that there will be 7 rate hikes, taking the Fed funds rate up to 2%, but that the economy, in Ethan's view, can handle it. And then Steve's idea that maybe a soft landing can be engineered. Where are you on this, and what is the implication for a bull market continuing?
Well, I'm inclined, and I love Ethan. I've known him my whole career. I'm inclined to have Kelly's stated response or proposed response, roll my eyes, say this is crazy, no way. I think if the Fed were to raise rates 7 times this year, my thesis for an imminent bear market would come to pass. Now, the piece I wrote for CNBC.com also included something that Stan Druckenmiller, the legendary hedge fund manager, taught me decades ago, that the onset of a bear market can be triggered by rising interest rates or impending war. And we're staring down the barrel potentially of both. So I am a little bit worried that in the case of Ethan being right, we'll definitely get a bear market. In the case of Steve being right, we may not. But in any event, I think the risk is rising because of those two things that we're looking at right now. When you look at the Russian market down with oil up at the same time, when you look at yields on the long end coming down, a little flight to quality there, and you look at what's been going on within the market, I think the case can be made that there's still more downside to come.
It's interesting, Michael. I'd like you to react to what Ron said and whether you think the odds of a bear market have risen, which does not necessarily mean that one is going to happen. But I have to say that earlier this week and for the past several weeks, while the market has been going through its spasms, mostly going down, then coming back a little bit, but it's mostly down this month, I have been surprised that more analysts like you and your peers haven't pointed to the possibility of a war in Europe where NATO troops are firing weapons at Russians and Russians are firing at NATO.
Tyler, I think first what Ron said makes a whole lot of sense. I mean, you know, particularly if you get close to a 10% is a correction, 20% is a bear market. If you're sort of making some progress down and you've got a lot of headwinds, sure, the risk of a bear market is out there now. In fact, we've had, you know, pretty much recessions every time the Fed has gone through this rate tightening cycle. I mean, it's very predictable, a lot of consistency there. And bear markets can occur on either sides of those recessions. So I think that 7 rate hikes, by the way, I don't see it. I can't imagine it. I think that the economy is too fragile. I think that our base rate is too established at near zero. I think 3 or 4 rate hikes, and I think you're going to see the economic data, particularly the inflationary data, slow sufficiently that the Fed will probably readjust over the summer. So I'm a bit of an outlier voice, and I disagree with 7 rate hikes. I don't think we can take it. Denial is my answer to what's going on in Ukraine, what's going on with Russia. There is real fear there. Greg Valliere wrote this morning in his piece that things could even become more heated in Ukraine. That bit of sort of exogenous, unpredictable event is precisely the kind of a thing, as Ron was saying in his comments, that could turn us into a bear market and could easily, if it's dramatic, take us into recession, too.
Shepard Smith here. Thanks for watching CNBC on YouTube.